Lakshmi Iyer, CEO of Investments and Strategy at Kotak Alternate, is with us ahead of the policy. Lakshmi, great having you. Now I can say as always.
Thank you so much.
No, great having you. So, what do you expect today?
Deja vu. looks like it. And I'm not the cast in movie Fukre, so I can't say a deja vu, but deja vu is what we are expecting. But I think a couple of things which are really worth mentioning is a lot of developments have happened globally. When we went into the April policy, we had a Swiss bank rate cut. But now we've had Bank of Sweden rate cuts. We've seen the ECB and Bank of Canada doing rate cuts after 5 and 4 years respectively. Not that it is going to change the apple cart quite dramatically, because none of these central bankers have indicated that it's going to be a series of rate cuts. So it's a one-off, testimony to the fact that inflation globally is also cooling off. But then you have Niagara Falls, US, which is clearly saying that... Yeah, absolutely. Well, the inflation data there is coming benign, but I don't think they are giving any indications to the market yet that they are in a mood to relent. So I think from that perspective, it will be slightly interesting to see what will be the narrative. Outer chances may be there, I think the Dil Mange More factor, where people are saying thoda stance change hoga and stuff like that, but not 100% sure or not very high on confidence if that should happen.
But stance change hona chahiye. I mean, you've got monsoon where we have to watch out for what happens. Very high chance that we could see some populist measures coming back. You've got geopolitical risks, so there could be that slight outer chance where crude may once again start returning back to levels that may be uncomfortable, and the heat wave that's behind us. So all those factors are only going to mean that inflation could see an upside risk, you'd agree?
No, I'm with you totally. So crude oil prices, again, we keep tracking policy to policy, what has been the change. This time it's down actually 15%. But look at industrial metals, they're up 20%.
Yeah, commodities, you're right. China might be coming back, so
Absolutely. So you look at every other aspect, sans crude oil, everything is actually, even soft commodities are up. So you're absolutely right, and food inflation. So while the headline is okay, we don't really have to worry too much about it, but food prices are still...
And growth is great. I mean, I don't even see why we wouldn't talk about a rate cut. Even if the Fed moves, hypothetical, India doesn't have any reason to cut rates, because if you've got inflation that may slightly be uncomfortable, you're growing at 8%. What's your complaint? Where is all this extra money going to go into, right?
No, totally. That's why these would be outer chance, not base case assumptions. Base case assumption is still the
status quo.
Plain vanilla status quo, and it's okay to be boring sometimes. It's absolutely
no action
fine.
Is action.
No, we had a lot of action.
Yeah, that's true. Actually, we've had lots.
Yeah, and we need some time to recoup, and it's just weekend. So I think just too much of action also drains you off. So I think this should be okay. Things are going good. One doesn't want to distort the apple cart too much. And of course, some of the thought processes I think may need articulation, including the dividend that RBI gave to government, for example. I think some of those things will probably hog center stage rather than policy action alone.
Yeah, the dividend for sure. But sorry, I just want to debate that point that you just earlier made, both of you. The RBI in its guidance for what inflation could look like, trajectory, right? Q2 is a meaningful dip that we are likely to see, right, as per the trajectory given. Sure, that could get altered a little bit because of this uptick, but not meaningfully, maybe because of the base effect too. Why not, if not now, but why not a rate cut in order to spur growth? We are at 6.5, it's good, not necessarily great.
So, if you look at on an absolute basis, the numbers are fantastic. If you look at it on a relative basis also, the numbers are brilliant. The country next to you is growing half of you. That's point number one. The largest economy is growing 1/4 of you. So I think with all of these put together, and we discussed this last time also, is rate cut a very necessary ingredient as of today to get pump priming the economy? The economy is already on a strong footing. So just trying to, populate your food is already reasonably palatable. Why would you want to spice it up further?
Being boring is good, like she said, right? Lakshmi, so while, of course, you said we'll be watching out for commentary, there'll be commentary on where that dividend came from. I'm not sure how that matters, but nevertheless, it's going to be important in terms of what they say. a lot of the commentary will be there that we'll watch out for, but will it have, it's great commentary, but will it have any impact on the debt market in terms of actionables, you think?
Very unlikely again, because again, if you go back to the previous policies, and this dates back to maybe even the last 5 or 6 quarters, or the bi-monthly policies, clearly telling you that the yield movements have been pretty much range bound. The only trigger today, if you ask me, that could probably lead to a downward movement of yields, because is a slightly dovish talk, not necessarily the walk, because we've seen whatever has happened right now, and or a stance change, which again I would say 1 in 10 probability. But anything of that sort happens, you could see yields going down by maybe 7 to 8 basis points, but that's about it. Are we talking about a massive? That trigger can happen only if you get a kind of explicit guidance towards rate cuts, which the markets are anyways giving you, right? If you look at the interest rate swap markets, they are talking about nothing before October, for example, and a rate cut probably in calendar year 2025. If you look at Fed fund futures, the probability is just about 40 odd basis points.
70% apparently for a September rate cut.
Yeah.
It just keeps getting delayed.
Yeah, exactly.
When we spoke in December, I still remember around on Editor's Cut, we were also convinced that there was a rate cut coming. You walk on a buy duration. It was almost like it was, this, we'd all made assumptions that didn't play out, and now we keep pushing it out.
But inflation is actually cooling off even in the US.
Is it?
Yeah, marginally, but definitely the trajectory is on the lower side. And but as I said, is it necessary and the only ingredient for getting into a rate cut? Probably not. So I think some of those factors, and as I said, you're wearing a policymaker's hat, you don't need to be having that temptation to give in at every macro data. So it's okay to elongate, and that weight makes the markets even more exciting breed to deal with, I would say.
So, Lakshmi, you reckon that Shaktikanta Das and the MPC will play by the template of not taking any action before the Fed moves, or given a chance and given an opportunity and given a condition, if inflation is lower and growth maybe stalls a little bit here and there, can they move even before the Fed?
I would say it's okay if they move in tandem. Moving together will be a better thing, because ultimately we have to also solve for the currency.
Yeah.
That's very important. We do have a significant war chest. I always say our brahmastra is our forex reserves.
Yeah.
But why to kind of, let it go for things like these where the situation doesn't warrant? I always go back to basics. If the situations don't warrant,
sure.
We don't really need to be taking the lead position in this.
Yeah.
And things are going good. It's not that there is no credit growth. It's not that any of these things. If any deposit mobilizations, if they need to go up further, you require rates to be where they are, not really come down.
Also, Lakshmi, you said before we started this conversation, you've got a lot of global LPs. How do they view India paper right now? Is it attractive to them? And also, what happens to existing investors? We've seen yields move down over the last few months. After many years of course, testing debt market participants, have they taken profits off the table, or have they added more allocation in Indian paper?
Looks like they're adding more. And they may continue. So if you look at the entire calendar year last year, the net purchases by foreign investors was roughly around little under 60,000 crores. And just 5 months, June has just started, just 5 months into the year, they are net buyers by almost 50,000 crores, which is a big number. And looks like that trajectory will continue, because see, US yields are at 4.3% and Indian yields are close to about 7%. And if you adjust for the currency depreciation, which may not be as severe as you've seen in the past few years, I think we're still doing about a net 5.5.
And this money that's coming in is held to maturity for the next 3 to 5 years, or is it easy money that will keep coming and going as soon as you see the alpha generation?
This is predominantly the stickier money.
Okay, good.
Because you have the impending index inclusion as well.
Oh yes, JPM. We've talked about that too so much.
Yeah, just one. Actually, from my end, one question, final question really, and which is around what do you anticipate this, because we haven't had a chance to talk, I think, post the dividend coming in, right? So the dividend coming in, plus the JPM bond inclusion, so on and so forth. A few people laid the bet, and they are on the losing side, that we will see 6.75 before June 10th. I don't think that's happening, but I would love to know what your trajectory on the yields is like.
See, while I don't have claim over astrology, but I can still tell you that without getting into dates, are we headed towards a downward movement in interest rates? The answer still remains to be yes. Could we probably test, we're at 7.05 depending on which benchmark you look at. Could we see at least a 15-20 basis points easing over this whole quarter, which is the next 2 or 3 months? Well, the answer is a yes. We cannot deny the fact that this bazooka that RBI has given the government of India can aid in not only the deficit reduction but also priming some capex growth. Yeah. In what proportion, we have to wait for the details. And as I said, the entire central bank crew globally is pretty atal that in this policy maidan, they want to be victorious.
Okay. No, sorry, I didn't mean from a astrology perspective, but more from a perspective of when do you get, if somebody is waiting on the sidelines trying to get into paper, is this a good time, or maybe waiting for 2-3 months is a good time?
No, absolutely. I think delayed gratification doesn't work right now.
Okay.
It's
and
okay
timing these markets is again a failed exercise. We've seen that in the last 2 years, right? Just one quick question, and going back to where you said you've seen foreign money come in. But the anticipation, don't you feel, was so much higher? The last 2 months has actually seen an outflow from debt markets. Do you feel that between now and the inclusion and what happens post that, maybe, just maybe, we were overestimating the inflows coming in from foreigners?
I don't think so, because even if you look at the month of May, as I said, June is still underway, the FPI buying in fixed income is still net positive. Equity still continues to be net negative.
Yes.
So, of course, the pace has receded a little bit because even they are keen to see how the political scenario would have unfolded. Right, wrong, we don't really know.
So what did your clients say after what happened on Monday, Tuesday?
They're
still
happy.
Constructive?
They're all happy. I mean, happiness is a very sweet quotient to have. And why not? I mean, you are having a third tenure of the same government and 15 years. I think in fund management parlance, consistency for 15 years is brilliant. Brilliant is an understatement. So you can't have, things any better. And I think markets have been rewarding it in the same
actually,
manner.
I want to get your view on it, because Neeraj and me were discussing this. When an outsider looks at India, is it an India equity versus India debt, or is it India debt versus, say, Japan debt or Europe debt or Germany paper? What is the comparison?
The comparison is typically EMs, which is EM versus EM in the same asset class bucket.
So it's okay.
And
so
DM
it's not
versus
country specific, it's asset.
That is correct.
Any quick one on the dollar rupee, if you have a view? I mean, it's been such a stable currency. This one is boring for sure.
No, as I said, the past 4 to 5 years, the pace of depreciation that we have seen looks very unlikely that that kind of magnitude may continue. So while the depreciation will still be the order of the day, the pace and the percentage could be much lower.
Well, Lakshmi, lovely talking to you. I dare say, when you are here the next time, we'll try and talk about the interest rate cut trajectory, if at all coming up or not.
Absolutely.
I love to wager some things, even though you are not, as you said, an astrologer, but lovely having your thoughts.
You know something, Neeraj, all the low probability things are manifesting, so you never know.
Yeah, you're right, actually.
Today could be well such day, you never know.
I'm a journalist, I love to provoke.
And I'm an optimist also.
So optimist means a rate cut is what you're hoping for?
But today I'm a pragmatist.
Thanks. Thank you, Lakshmi.